Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Beijing Chunlizhengda Medical Instruments Co. Limited Annual Report. Beijing Chunlizhengda Medical Instruments Co. Limited offers a wide range of medical instruments and related products. The company's product portfolio includes implantable orthopedic devices such as joints and dentures, as well as spine-related products. In addition to these, they also provide sports medicine and trauma-related surgical instruments. Their services include the production and trading of these medical instruments, which are sold through various channels such as distributors, ODM, original design manufacturer, and OEM, original equipment manufacturer, bases, and directly to hospitals. The company also engages in exporting its products globally. With a strong presence in China since 1998, Beijing Chunlizhengda Medical Instruments Co. Limited has established itself as a reputable player in the medical instruments industry. Beijing Chunlizhengda Medical Instruments Co. Limited maintains a market capitalization of 8 billion, broadly in line with the industry peer group. Beijing Chunlizhengda Medical Instruments Co. Limited trades at a higher price-to-earnings ratio of 27 times and a lower price-to-book ratio of 1.48 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The balance sheet appears very conservative, with liabilities representing only 19% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The company have a dividend yield of 2.14%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. Additionally, special charges appear non-recurring, suggesting high earnings quality and strong financial resilience. Net income and profit margins. A significant improvement in 2025, the company's net income experienced a remarkable turnaround, increasing by $425.4 million compared to the previous year. This significant improvement is attributed to a substantial increase in operating profits and revenue growth. The profit margins also saw a notable improvement, with the operating profit margin rising from 16.3% in 2024 to 28.7% in 2025. Similarly, the net profit margin improved from -9.1% in 2024 to 29% in 2025. This indicates that the company has become more efficient and effective in generating profits. The key drivers behind this improvement are a substantial increase in operating profits, plus 130.6%, and revenue growth, plus 30.3%. These factors have contributed to the company's ability to generate higher profits, leading to improved net income and profit margins. The company's financial performance indicates a significant milestone. One of the key indicators of a company's health is its ability to generate positive operating cash flow. This means that the company is able to produce more cash from its operations than it spends, resulting in a net increase in cash reserves. This achievement is particularly noteworthy as it suggests that the company's business model is efficient and effective in generating revenue. The company's management team should be commended for their efforts in optimizing operational costs and maximizing profitability. As a result of this positive operating cash flow, the company is well positioned to invest in growth initiatives, pay off debts, or return value to shareholders through dividends. Overall, the generation of positive operating cash flow is a strong indicator of the company's financial stability and its ability to sustain long-term growth. The company's debt level and interest expenses have undergone significant changes in recent times. a notable increase in total liabilities is observed, with a rise of RMB 29,751,553.5. This indicates that the company has taken on more debt obligations. However, despite this increase in debt, the financial expenses, which include interest expenses, have actually decreased. The financial expenses dropped from RMB-17,067,794.63 to RMB-11,396,352.36, a decrease of RMB 5,671,442.27. Furthermore, interest expenses specifically have also seen a decline, decreasing from RMB 44,939.07 to RMB 39,150.21. These changes suggest that while the company's debt level has increased, its interest expenses have actually decreased, indicating some cost savings or more favorable terms on new debt obligations. Management's outlook on company strategy. The company's management has outlined its strategy for the future. One key aspect of this plan involves utilizing temporarily idle capitals to drive growth. This approach aims to increase production capacity and acquire new facilities, ultimately enhancing overall capital returns and ensuring liquidity. By leveraging underutilized resources, the company seeks to optimize its financial performance and maintain a healthy cash flow. The company's financial activities have been transparent in their annual reports. One notable aspect is the payment of dividends to its shareholders. According to page 27, the company has indeed paid dividends, indicating a commitment to rewarding its investors. In addition to paying dividends, the company has also engaged in share buybacks. As stated on page 35, this move demonstrates the company's confidence in its financials and its desire to return value to its shareholders. By buying back shares, the company is essentially reducing the number of outstanding shares, which can lead to an increase in earnings per share and a more stable stock price. Concerns have been raised regarding the potential for inventory buildup and supply chain disruptions. One specific issue is the risk of impairment losses on assets, which can occur when provisions are made for inventory impairment. This concern is highlighted in a particular section of the report, page 24. The possibility of inventory buildup can lead to inefficiencies and wasted resources, while supply chain disruptions can have far-reaching consequences, including delays and increased costs. That concludes the financial summary for Beijing Chunlizhengda Medical Instruments Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.